welcome to the CNBC-TV18 special. I'm Shereen Bhan and we're in conversation with Akash Prakash here in Singapore. Akash, thanks very much for joining us on CNBC-TV18. I can't help but notice I walked into your office and the first thing that I saw was Alan Greenspan's The Age of Turbulence. And what an appropriate way to actually start this conversation. At least the Fed action or the lack of it for now seems to be off the table. Do you believe that that is going to sort of weigh as far as investor sentiment is concerned and the volatility that we've sort of gotten used to over the last couple of weeks, is that going to be a thing of the past, at least in the short term?
Yeah, I mean, I frankly wish the Fed had hiked by 25 basis points and got that,
out of the way,
bogey off the back and said, I will not hike for 12 months after that. So I think it's going to remain a turbulent time globally because, you have the situation of, you obviously have the EM as an asset class is under serious stress at the moment for various reasons, strong dollar, weak commodities, China. I don't think that goes away immediately. I think the concerns around EM are going to remain there. I think the Fed is in that sense important, but not the critical reason why EM is in stress. It's not the only reason. So I think it remains a sideshow. It remains. But is
it really a sideshow? And I go back to Alan Greenspan and he said, why is the world obsessing about whether the Fed is going to hike or not? Because at the end of the day, it's going to be a 25 basis point hike, at least as far as this calendar year is concerned. But we've in expectation, in anticipation of what the Fed is going to do, we've seen so much volatility and so much churn in our markets.
Yeah, but I'm not sure it's entirely because of the Fed. I think, to a certain extent, China has taken over that role of creating volatility, right? I mean, one, of course, you had Europe and Greece, which now seems to have gone away. Then you've got China, right? And China, I think, is, now over the last 7 or 8 years has created more economic growth than the US and Europe combined.
Right.
And there is great uncertainty around China in the sense because of the unreliability of the data and the fact they're changing the growth model. No one is 100% sure what exactly is going on. So I think that is the bigger source of volatility. The Fed obviously is there. It is a kind of, the elephant in the room to a certain extent.
Yeah.
But I don't think that's the main reason why the volatility has happened in the last couple of months. I think really it's more China and more fear around emerging markets. And I think it's a general fear around emerging markets growth model itself. Because EM countries have decelerated dramatically. There's no earnings growth. A lot of them are having stress on the current account. So there is, I think, there's a general reassessment that is EM really going to be able to grow 300-400 basis points faster than developed markets for the next decade, which is what the conventional wisdom was. I think the reassessment of that. And that is creating the volatility as well. I mean, I'm not saying the Fed is not relevant, but I don't think it's just the Fed.
But given the reassessment on account of the pain that we're seeing in emerging markets, and that, of course, is impacting markets like India, even though we are poised much more, we're in a better spot in comparison to the rest of the emerging markets at this point in time. But do you believe that reassessment, because everyone's been overweight India, is going to continue to impact us in the short to medium term?
I think it will now because, India is, I've written about this, India is a consensus overweight. If you look at any survey of fund managers, India has never been a higher relative or absolute weight than it is today. So in a situation now, if EM continues getting outflows, which is what's been happening for the last 2 months, it's very difficult now for fund managers to not sell India if they keep getting outflows. You can't keep raising the weighting beyond the point, right? There's risk control measures, there's absolute risk you're taking. So if EM gets outflows, India will get sold because people don't have a choice. And that's what you've seen in the last 1 month. I think the domestic flows have been strong, so we've compensated. But I think India now is going to be held hostage to EM flows as a whole. Because frankly, our weights can't go up much more. I mean, that's reality. What do you do?
So what does that mean then as far as the index, for instance, is concerned in this particular calendar year? We've already seen downward revisions as far as the index level is concerned. But in the short term, how much more pain do you believe we are likely to see for our markets?
Well, I wrote an article saying that, at 7,500 saying that I don't think you should panic and sell. I don't think the market has huge downside. The caveat to this, of course, is that, it's almost like a question of who blinks first, like Coke versus Pepsi, right? So the foreigners will keep selling. So will they stop selling? Or will the domestics stop buying? So you have
the domestics at this point in time are having a bit of a party in the market.
No, but it's good. But the criticality is that historically, through periods of high volatility, domestic flows have not sustained, right? This time it's looking like it's different because even through the months of August, flows were all-time high. And my friends in the domestic mutual fund industry all tell me that flows are still quite good.
Yeah, and the conversations that I had with people who are talking to domestic institutions say that they believe that flows will continue to be robust and there is something different this time around.
So if you believe that, and I do believe that's true, and if you believe that, I think the downside is not very dramatic. So I would say maybe 7,500 on the Nifty, maybe 7,200. I don't think it goes much below that because there is the strong domestic buying power which is continuously coming. And but literally it is that the foreigners are selling and the domestics are buying. And who blinks first. Right, so we'll see.
Speaking of the strength of the India story, and I remember you'd written, I think this was in June when you had visited India and spent a couple of days talking to policymakers. Do you get the sense that the story or the direction, I mean, consistent, yes, in line with what the end objective is as far as this government is concerned, but in terms of follow-through action, in terms of actually putting the nuts and bolts in place in terms of execution, are you still feeling as confident as you were in June?
Yeah, I think it's a mixed picture in the sense that as investors we obviously hope that things are done faster, right? Because investors have a very simplistic view of the world, right? You want something done, you want it done, and you don't normally realize the political compulsions, or India is a very, as you know, a very complex democracy, so it's not so simple to get things done. So I would say the picture we would wish to be faster, but also depends almost on sector by sector and minister by minister. So for example, if you look at railways, the feedback is actually very positive, that there are lots of things happening and Mr. Prabhu's done a really good job and things are really going well. You look at roads, there's a lot of positive news. There's some renewables is very positive. Power transmission is very positive. Now distribution is still a question mark with DISCOM. Generation is a story of huge success, ironically, in the Congress time. There's so much generation capacity now that frankly we're a power surplus almost country, literally getting there. Right? So I think it's mixed. Is it a universal everything great? No. Clearly we want things to happen faster, but I think it's also unfair to say that nothing has been done. I think there is a lot of stuff, and also they inherited a bit of a mess, clearly, right, in many areas, and a lot of stuff they're stuck because there's judicial involvement or there's some case or some judgment that you can't get out of. So I wish they were faster, but I do believe the direction is clear, and if they would, just got to keep working at it. I mean,
yeah, sure. And since you were talking about some of the sectors where the government has allocated a lot more money, railways, roads, and so on and so forth, and the emphasis right now is private sector is not spending. Significant parts of private sector are seeing stressed balance sheets, and that's sort of weighed in on their capacity to be able to spend or invest at this point in time. And so the government must take the lead, and hence we're seeing public expenditure move up in areas of infrastructure and so on and so forth. Do you believe that will continue to be the case? Because when you talk to industry at this point in time, demand continues to be slow, consumption is taking a toll, we're not really seeing the need for new capacities to be put up, and yes, the balance sheet problem continues to exist.
Yeah, no, I think that is a fundamental problem. I think that India is going through a balance sheet recession in the private sector, which is that the bulk of the people, if you look back at the last 5 years, the big areas of capex were really power and commodities, ferrous metals, aluminum, steel, stuff like that. Those sectors are all challenged, right? I mean, steel and commodities, we know what's happened globally. Power, self-created problems. So there's, I was reading the consultant office yesterday who said there's 30,000 megawatts ready to start, which can't, but don't have a PPA. And there's 50,000 megawatts behind that, which is in various stages of completion, which is stuck, right? So anyone involved in these 3-4 big areas, which were the bulk of our investment, is in stress, right? Clearly, either they have a balance sheet stress or the banks won't fund them. So this balance sheet repair will be very protracted and will take a lot of time, which is why the drivers of capex this time are reversed. It's railways, it's roads, it's not power generation, not aluminum, it's not steel. It's railways, roads, and maybe transmission, stuff like that. So I think you're going to have to change first the mix of what is the driving investment, which already happened. Then second is that the balance sheet repair is going to take a lot more time than people think, because how do you clear these assets? So either you've got to get a lot of FDI people buy these assets, or somebody has to come and buy these assets. So I think the government really has no choice, that you're going to have public investment first, and that will slowly crowd in private investment. I think private sector India has neither the willingness or the ability to invest. There are obvious exceptions, but I'm saying if you look at the big drivers, who are the big investors of the last 5 years, they don't have either willingness or capacity.
But is the infrastructure side of the story looking better to you, given the fact that there is emphasis now on getting things moving on the ground, whether it's railways and of course the multiplier impact on that, whether it's roads, the exit policy, for instance, as far as stress projects are concerned? Does that mean that things are looking better now as far as the infrastructure side of the story is concerned, light at the end of the tunnel for those companies?
I think there's some there, because with some of the companies we talked to there.
Would you look at them?
We, for the first time, are looking at them. For the first time, we've invested in a company called Sadbhav Infrastructure Projects, right? So we were an anchor investor. For the first time in our history, we invested anything remotely related to infrastructure. So I think there is a situation there where the policy framework has become better. Competition is far more rational, because the bulk of the competitors who were irrational have all been wiped out. there's a lot more government money coming in. There's a lot more rationality on the part of government of understanding that I have to let people make some money to help them repair their balance sheets and to and otherwise I can't get investment. So I think, I mean, I'm not a great fan of infrastructure per se because they are fundamentally not great businesses because they can't be, right? You can't have public infrastructure earning 25% ROI. I mean, it doesn't make sense. You'll be massively overcharging the consumer, which is not which is why they're natural monopolies and regulated. So I think occasionally you can get an interesting company, but I'm not a great fan because they're not great businesses, in my opinion. They don't generate huge cash. The returns will be and should be regulated. That's fine.
Okay. Change of heart even as far as public sector banks are concerned, or it's still wait and watch for you? You're still assessing the strength of the story.
No, I think that for the first time, positive banks I think are something which we have to look at very closely because I do believe what they're trying to do in the Dhanush. Obviously, we want more, right? I would ideally want the full PGNAC committee to be implemented. Sure. But obviously, there are, I guess, constraints, either perceived or reality, political, to get those things done. So within that, is this better than what was there before? Obviously. I mean, if you're getting someone like Ravi Venkateshan as chairman of Bank of Baroda, someone like Jay Kumar as CEO of Bank of Baroda, that is radical change, right? I mean, these guys it would have been unthinkable in the previous regime to get someone of that type to be either chairman or CEO. So I think we've got to see what happens.
So you wouldn't put in money just yet?
No, I think it'll take time. I think that we still need to see, first of all, will the new people, do they get the freedom they promised? Do they have the ability to do what they want to do in terms of making the changes? And I think, so I would say from my point of view, it's gone to a situation where I was not even keeping track of what PSU banks are doing.
So you're now at least looking at that?
I'm definitely looking at it. And not all. I think the government really clearly said you should look at only 5, and looking at those 5. So at least it's back on our radar. Have we made the investments? No, but we will clearly watch and see what happens.
What about the private sector banking space? And we're seeing a bunch of changes within that landscape, which is going to make things even more competitive. But there is now the possibility, or at least it's a proposal being pushed by the banking sector, the private banking sector, to the government, that hey, let it be 100% foreign direct investment. It's a matter that's being looked at. There's been no decision that's been taken, which is what the finance minister told me. But what about the private banking sector at this point in time?
No, I think the private banks in India are outstanding businesses, right? It's a very positive business model because you have 70% of the banking system owned by the PSU banks, which till very recently have been quite challenged on capital, technology, ability to pay market-based compensation. So that's your big chunk and is undercapitalized, right? And you have the foreign banks, which are either controlled because they have problems overseas, or the RBI has control on what they can do. So you have the niche in the middle, which are private banks, which are probably as good as the foreign banks in technology and capability, and don't have the constraints of the foreign banks. So it's a great business model. You can underwrite 15-20% earnings for the next, as long as you can underwrite credit well, you can do very well. So I think they're great businesses, but they're very expensive. Right? I mean, the HDFC Bank is 4 times book, and whatever, the Axis Bank is 2.5 times book, and Kotak is 5 times book, whatever. So I think the issue there is finding a bank at a value that you're comfortable with. So
and you're not comfortable with any at this point?
No, I think we own some. I don't want to get into specific names, but we do own 1 or 2 of them. But the issue there is, I think, to make outsized returns from here is going to be difficult there because there's no scope for PE expansion or price to book expansion. But will they grow at 15, 20, 25%? I would say very high probability because it's a very, because of the structure of the industry where the 2 ends can't grow anywhere near what you can. I think it's a very advantageous position to be in. The question is, what will you pay for it? That's the issue.